53,000 crore rupees, or about $5.5 billion. That is the volume of capital currently moving into the Indian banking sector in a single transaction. The core event is the selection of Canada-based Fairfax Financial, led by Prem Watsa, as the preferred bidder for a 60.72% controlling stake in IDBI Bank at 81 rupees per share. This capital deployment exceeds Emirates NBD's 2025 acquisition of RBL Bank, making it the largest foreign investment in an Indian bank to date. The target asset, IDBI Bank, maintains a legacy status and a significant physical footprint within India's financial system. Deconstructing this valuation requires analyzing three distinct layers: the dual seller cap table, the regulatory requirements, and the FY26 financial data. Assembling a 60% controlling block of a major bank requires a coordinated dual seller strategic divestment, rather than a standard open market purchase. IDBI's current ownership is split between the government at 45.48%, the Life Insurance Corporation at 49.24%, and the public holding 5.28%. Under this deal, the government is selling 30.48% of its holdings, generating an estimated 26,620 crore rupees in proceeds. The second seller is the Life Insurance Corporation, or LIC. LIC is divesting 30.24% of its holdings, expected to yield approximately 26,440 crore rupees. These combined blocks grant Fairfax a 60.72% equity position and absolute management control over the institution. The offer price of 81 rupees per share is 6.4% below the recent market close, a gap that accounts for the limited liquidity involved in moving a massive controlling block in a single transaction. This maneuver allows the government to meet its asset monetization targets while transferring management to the private sector. Preferred bidder status marks the start of a multi-stage approval process. The first requirement is the Reserve Bank of India's fit and proper assessment, reviewing the buyer's financial and regulatory standing. Clearing this leads to a mandatory open offer to public shareholders, which may increase the total capital Fairfax must commit. A specific structural conflict exists because Fairfax already maintains a 40% stake in another Indian lender, CSB Bank. Universal bank promoter ownership limits in India prevent a single entity from operating two competing universal banks indefinitely. To resolve this, the regulator will require Fairfax to merge IDBI and CSB Bank into one entity. The $5.5 billion valuation accounts for both the equity purchase and the commitment to this complex integration process. The audited FY26 results explain why a buyer would accept this regulatory complexity. The bank's total business has now crossed the 6 trillion rupee mark. Net advances grew 16% year-over-year, showing a rapid expansion in lending. Total deposits funded this expansion, growing 12% over the same period. The loan book is composed of a 30-70 ratio between corporate and retail advances. This heavy retail weight reduces the risk of concentrated defaults, as the debt is spread across millions of individual consumers. These factors resulted in a 27% increase in net profit, which reached 9,513 crore rupees for the year. Profitability was supported by a net interest margin of 4.15% in the fourth quarter. These results characterize IDBI as a high-margin commercial engine. This performance is a shift from 2019, when IDBI required a state-led bailout to address significant distressed assets. Current data shows the asset cleanup is largely finished, with gross non-performing assets falling to 2.32%. This is a 66 basis point reduction year-over-year. Net NPAs are even lower, maintained at 0.15%. The provision coverage ratio, or PCR, stands at 99.39% and has remained above 99% for over 2 years. A 99.39% coverage ratio means the bank has allocated reserves to cover nearly every recognized bad loan on its balance sheet. Capital readiness has also improved, with Tier 1 capital rising to 25.56%. The overall capital to risk-weighted assets ratio reached 26.65%. This capitalization level allows Fairfax to fund growth from the bank's existing resources without needing immediate external equity injections. The 81 rupee valuation is based on a sanitized, fully provisioned, and overcapitalized balance sheet. Looking past the balance sheet, this transaction influences the wider Indian financial ecosystem. For the Government of India, the deal executes a significant phase of the National Asset Monetization Program. The exit demonstrates the government's ability to use LIC to rehabilitate distressed public assets for eventual private market sale. For Fairfax, the initial capital and merger obligations lead to a clear operational outcome. As a result, they gain majority control over a 6 trillion rupee banking franchise in one of the world's fastest-growing economies. The next steps involve clearing the RBI's review, concluding the open offer, and beginning the integration with CSB Bank. The foundation of this acquisition is the coordination between dual sellers, a specific regulatory path, and a de-risked asset. The IDBI Fairfax deals serves as a measurable precedent for foreign investment and bank privatization in India.